or not? Here on set with us to answer that is Fundstrat economic strategist Hardika Singh. She's out with a note this week taking a look back at some of the other companies that have issued 100-year debt to see what that might forebode for, or just bode, I guess, for Alphabet and AI. Hardika, it's great to have you here.
Thanks for having me.
So everyone's talking, what was it in 99? Motorola was the big one? Okay,
yeah.
But widen the lens for us. How else should we be thinking about 100-year debt?
So thinking about just the age of Google and these Magnificent Seven companies, they're not that old. They're pretty young. You know, Google itself is 28 years old, and all the Magnificent Seven companies that we've had, they were created in the last 50 years. And then, to put that into perspective, AI itself is 3 years old, and Google's just taking a huge bet on it with this $100 billion bond offering. Putting it into perspective, other century bond offerings were done by companies that were, you could say, boomers in their age, right?
Really? Is that right? Was Motorola like a 60-year-old company?
Yeah. And
so do you generally say this from the point of view of it's better? I'm trying to pick an analogy that doesn't sound, to try to, take the medicine for hair regrowth, right? I mean, is it better for them to chase this idea that this CapEx will make them young again? Is that how it actually ends up working or not?
That's a big question on my mind right now, especially because let's take, for example, Disney. When they've had their century bond offering, they were about 70 years old. And even back then, there were all these concerns about the entertainment industry, especially back then when there were many questions about how it was going to revive itself. People in the Wall Street Journal, when they gave quotes, they said, oh, this is kind of a silly idea. This is a crazy thing. Look at what happened to Coney Island, for example. So I think it's just a matter of, can you as a company keep disrupting the space you're in and reinvent yourself? Because it's 100 years. It's a really long time.
Yeah.
Well, I think Google, from the diversification perspective, they continue to be like their own little Berkshire Hathaway. So it is interesting they're coming to market, but the subscription, the oversubscription, it really talks about the appetite in a time when should investors be concerned with these 100-year bonds, which are remarkable. Maybe we live to 100 with all the robots about to help us, Kelly. But what we see is the appetite for this. We're about to have SpaceX potentially this year, which is going to be the largest IPO of all time. Meanwhile, you're seeing $25 billion, $30 billion from Amazon, from Oracle. Should we be concerned at what point of this financing really is the undercurrent in the marketplace?
Yeah, there's a lot of demand right now for these bond offerings, right? The oversubscription, my eyes just pop,
yes.
10 times. That's crazy. But again, I know these big tech companies, they've lost their cult-like status. But at the end of the day, the oversubscription kind of shows to us that, investors haven't completely given up on these big tech players yet. And I think that's a really good sign for the broader market because there's such an outsized portion of the market. If they don't rally, how hard is it for the broader market to keep pushing to all-time highs? And right now with the software stumble, I'm really thinking about that.
When you went back and looked, did it make you come away from it? Because I love hearing about the stories we've forgotten about. I wish I could do a whole series of the news we've forgotten, right? The Disney one you mentioned is so fabulous. Does it make you look back and think, you know what, these companies should have been more aggressive because all of these concerns were overblown? Or does it make you think, no, I mean, these typically were the signs of a business model at its peak and they didn't see that the cliff was coming?
That's a great question. I think that, yes, some of them should have had the oversight. For example, JCPenney, they also had a 100-year bond offering back in the late 90s.
Wow.
And guess what? They went bankrupt 23 years later. So the bondholders for the 100-year bond, they got nothing out of this.
GM was a bad one, too.
Yeah.
Was that as long as bad?
Well, the bondholders got the
But
haircut.
was it a century or 30 or long term?
It was longer.
Yeah.
It was longer, yeah.
Wow, for GM.
Yeah. So with the duration risk, too, it's you can make the money back. But at the end of the day, if you are a long-term insurance company, for example, you have long-term liabilities, you're a hedge fund, you are looking for, high convexity, you kind of want the bond to continue paying out for the duration you thought it was going to.